Welcome to the Science of Retirement Investing, and this is a look at how investing really should be done as opposed to the way so many of you have been doing it in the past. It's a lot different than you might think. I'm Don McDonald from the radio show and podcast Talking Real Money. You probably listen because that's probably how you got here. And we hope you'll listen to both the show and the podcast. You can listen to the show live even if you're not in Seattle. You just go to talkingrealmoney.com and there's a link right there to listen or listen to all the podcasts. We appreciate it. Tell your friends too. So let's talk about investing and real investing. I believe they're two different things. I had to make up the term real investing because so much of what passes for investing really isn't. For example, buying Bitcoin. That is not investing. That is purely gambling. It can't grow larger. It can't increase its value. It's all based on greater fools. Buying individual stocks. I don't believe that's real investing. The real difference between investing and real investing, though, is science, academic research. And we live in a great time in that we have access to almost a century of market data. And we have all kinds of people who have been studying that data and publishing papers and doing research and explaining it to us in a way that makes sense. And it's all this science is based on a simple concept. Risk versus reward. Higher risk must provide a greater reward or people will not take that risk. And that's been a consistent truth over time. If you want a high return, and who doesn't, you have to take more risk, but what you want is low risk. That's why you succumb to so many con artists. You cannot have wealth without risk. If you want a high return, you must accept high risk in one form or another. And that's what I'm going to get into. I'm going to get into a way you can reduce the inherent risk and play a little bit with the perceived risk. So it makes taking risk for that higher reward more palatable. And you know this. If you go to a bank and you put your money in a bank account that's FDIC insured, your risk is low, but so is your reward. These two terms really should be tied inextricably together, almost like one word, risk-reward. Now, the great data we have goes back to about 1926, economic market data. So let's go back to 1926 and look at a single U.S. dollar bill. After the effects of inflation through 2019, $14. That's what a dollar would have been worth. $21 if you invested it in U.S. Treasury bills, $142 in long-term government bonds, 20-year bonds. And look at that purple line. $7,000 if you put it into the U.S. stock market. All the stocks in the United States, publicly traded. A lot more money, but you took more risk, but you were rewarded. How about if you did that red line? That's small cap stocks, little companies. Check this out, $20,445. Take more risk, you should make more money, and so far, you have. And the risk I'm talking about is really different than what you consider risk. Inherent risk. The risk of losing everything is what we all fear. We think to ourselves after we bought something like GameStop, why did I buy GameStop or AMC or whatever it was, or Kodak or Bitcoin? Well, actually, I don't even know where Bitcoin is when you watch this, so it could be way up, could be way down. That's Bitcoin. From many years ago, it was, why did I buy General Motors? Or why did I buy WorldCom? Or why did I buy that energy company in Texas that was supposed to be all the rage? They were really creative and entrepreneurial, and their stock was going to go to $90 a share within a year. Well, within that year, that advice went up in flames, and the stock was bankrupt. Buying individual stocks is too dangerous. You can watch your money vanish. Trying to predict or time the market doesn't work. Multiple studies done have shown that trying to time the market, day traders, for example, only about 10% fail to lose money. Make a little tiny bit. A tiny fraction of those make a lot of money, and 90% lose. You're going to be in the 90%, unless you're just extremely lucky, because you're not that talented. Sorry, you're not. But there's one thing we know. We can look back to 1926, and we can say with a degree of certainty that the stock market, the U.S. stock market, well, let's use the S&P 500, has gone higher over time. Yes, I see the dips. But if you notice, what followed the dip was always higher highs. You say, oh, the stock market's at new highs. Well, all along there was new highs, and then there was another new high, and then another new high. There have been new highs, following new highs, following new highs, following new highs. Why would that stop? Do you actually think the economy of the planet is going to fail? It's not. So you could have just simply bought the S&P 500 over time, and if you waited patiently, you made money, even if you bought in 1929 and reinvested your dividends. You made money over time. It took a little while, took a little longer back then, but since then it's been a lot faster because it's a bigger market. There are more participants. However, there's more to investing than just the market. You can actually increase your risk in a variety of areas, these dimensions of return, as dimensional funds calls them. For example, we know that stocks have outperformed bonds, right? We saw that on the chart. So there's a market premium. If you invest in stocks, you should make more money than bonds over time. Small companies have outperformed large. We saw that too, right? Over time. More risk, more return. Undervalued assets, value stocks, the things that Warren Buffett loves, they have outperformed over time growth stocks. Now, when growth stocks beat value stocks, you'll always hear the naysayers saying, value stocks are dead. No more value investing. It's over with. And it's not. It's come back again recently. It takes time. And I love this one. I call them all duh factors. Let's see. Smaller companies make more money than large. Yeah, they're riskier. Value companies make more money than growth. Yeah, they're riskier. How about profitability? More profitable companies make more money than less profitable ones? Huh. What a bizarre concept. Yeah. Fixed income. Longer maturities have to reward you more than shorter maturity bonds. Lower quality junk bonds have to pay you more than high-quality government bonds. So if you're willing to take more risk, you should be able to make more return, but you've got to do it smart. You've got to play it smart. And you can't be provincial. Yes, the U.S. is a wonderful place, but you shouldn't have all your money here. Half of it? Maybe a little more? Absolutely. But there's a world out there, and you should be invested in it because there are others making money. And there have been times when it's bailed you out, and I'll show you that in a minute. As a matter of fact, when I was in New Zealand a few years ago, I remembered reading an article in one of the papers that the majority of New Zealanders have the majority of their portfolio in New Zealand stocks. Look at this map. You want to see New Zealand? It's that little tiny square in the lower right corner. It doesn't even get a number, it's so small. I mean, look at its size compared to South Africa. It's a fraction tiny fraction of the global economy, and yet New Zealanders invest in New Zealand because they know New Zealand. That's not smart. They should really be less than 1% in New Zealand. British investors invest more in the United Kingdom stocks than they do elsewhere. They should only have 5% of their money in the UK. Canadians, same thing. A lot of Canadians listen. And by investing in the U.S. only, or your home country, you missed out on some of the best markets and some incredible performance over the past couple of decades. Look at 1999. Go down there. That's why I have what's the flag there of the little guy with the test tube? Yes, it's Finland. Finland, 152%. In 1 year? Wow. 2004, Austria, who would have thought, 71%. Norway, 2009, 87%. Wait, go down to the bottom. U.S. Was it the best market? Yes, once. In 2014. You want to own the whole world. Because owning the whole world has actually saved you from some really bad returns. Let's look back at what we called the lost decade, from 2000 till the beginning of 2010, 10-year period. $10,000 invested on January 1st, 2000, by 2010, declined to $9,100, even after dividends. Wow! You lost money over a full decade if you invested in what we call the market, the biggest companies in the U.S. However, if you put the same $10,000 in a globally diversified equity fund, you would have almost doubled your money. Now, a lot of people have forgotten that recently because the last 10 or so years have been so much better for U.S. stocks, particularly large company growth stocks, that we've forgotten the lesson learned in the past. Diversification saves you from big declines. And let me give you an even better example of that. The standard balanced portfolio is 60% stocks, 40% bonds. Now we're going to look back over 20 years, 2000 to the beginning of 2020. $10,000 in the S&P 500 grew to about $31,000 over that 20-year period. If you had that globally diversified in stocks with 40% of the money in high-quality bonds, short, intermediate duration bonds, you saw that 10,000 grow to 29, pretty darn close to the S&P 500, but we're going to talk from now on about risk differently. Stop thinking of inherent risk. Stop thinking of I could lose all my money, because with 500 stocks, you can't. With 13,000 stocks, come on, you can't, really. You could, but you won't care about your money in any scenario that would cause the entire global economy to collapse. So, who cares? We want to start talking about standard deviation. It's a statistical term. In a nutshell, just simplified, it means if something doesn't move at all, it has a zero standard deviation. If it fluctuates a lot, it has a high standard deviation. The higher the number, the greater the volatility, the greater the fear factor. Because that's what we really fear with a diversified portfolio. It's those big declines. With stocks, they could be 50% in a single year, and you don't know when that's going to happen. Standard deviation of the S&P 500, almost 15%. Standard deviation of a 60-40 globally diversified portfolio, just over 10%. That's a substantial reduction. That's gigantic. And let's look back at the bad market of 2007 to 2009. Where the S&P 500 declined 36% from over 2 years, from 7/1/2007 to 6/30/2009. Over 2 years, lost 36% of its value, while a globally diversified portfolio of stocks and bonds, and that was a global recession, only went down 20%. That's the kind of risk that a lot of people can tolerate. And it's just an example because we have to make this personal. Risk is a personal thing. How much risk can you stand? And that really translates into how much volatility can you stand? How big a worst 1 year loss can you tolerate? If you're in bonds, if you'd been in bonds from 1970 to 2020 over about 50 years, your worst year would have been a loss of 1.5%. Not bad. Your return, about 6%. With 10% in stocks, your return shoots way up, but your worst year shoots up to about 6% loss. Then we see 20%, returns are rising, worst year is falling, or worst year is rising, or falling, I guess, depending on how you're looking at it. We get to 40%, 9% return for the portfolio, worst year loss 20%. 60%, there's our typical balanced fund, 10.8% average annual return, worst year, 30% loss. Worst 1 year. 70, 80, 90, 100. You can see how the returns rise and how the worst year rises. And then we threw in the S&P 500 for good measure. And notice that the 100% global equity portfolio actually returned more money over that 50-year period than did the S&P 500 on average, and that's a pretty substantial increased return. Now, I want you to concentrate on this line, though, that bright yellow line. That's standard deviation. That's what we talked about, the volatility. The lower the number, the more comfortable the portfolio is likely to be for you. Let's go back to the S&P 500. You notice that the return was 12%. Standard deviation was 15.3. So you made 12, but you had to accept a pretty high degree of volatility. And your worst year was a 43% loss. If you put 60% in stocks and 40% in bonds, your return 11% almost. Standard deviation goes way down, 15 to 12. Worst year, 29 instead of 43. So you need to build the portfolio for your risk tolerance, and that means a tolerance for volatility. But it's hard to do this on your own. Every year, a company called Dalbar crunches the numbers on the actual performance of equity mutual fund investors based on their buying and selling patterns. People, individuals left to their own devices, tend to sell when after prices have fallen, sell low, and then they get excited after they've gone up for a while and buy high. And that has shown to be the case over and over and over and over and over again. The average equity mutual fund investor over 20 years made about 4% per year, while the S&P 500 made 6%, and a 60-40 global portfolio made 6.19. 100% equities, 8%. If you just bought them and left them alone, but the problem is we don't do that. We tend to focus on our emotions and not discipline. It's hard to do it alone. And part of the problem is we turn investing upside down. We're always asking, how should I retire? Or how will I retire? What should I be invested in? What kind of investment should I have? In fact, here's a woman asking those questions. How much will I need to retire? What kind of investments? How am I going to generate income? You got to have a plan. Start with a plan, not where will I invest, but how will I get to where I need to be and how much risk can I take doing it? And then you have to follow a strict discipline. You cannot panic, either up or down. There's an upside panic too. Having a fiduciary advisor can help you make better decisions and make more money. Vanguard has done a study that it's called their Advisor Alpha study, and they found that the value of a fiduciary advisor is about an extra 3% in return per year. Well, sounds like you could afford to pay somebody. Just the behavioral control is worth about 1.5% per year. You need some sort of guidance. You need a plan, because otherwise you're going to fall victim to a lot of bad deals. This was an actual ad on Google for 10% annual returns. High yield and low risk. I did not highlight that. They did. Short-term deals, 10%? There ain't no way. And then when you do things like this, you find out later on, and you'll never know in advance, that you made a bad choice. I didn't know I'd lose. Ponzi schemes. Bad investments. Almost nobody who invests has a plan for retirement. And yet we believe that every investor needs to start with a plan, which is why we created something many years ago called My Retirement Blueprint. We have since added a lot greater sophistication to that, a lot more in the way of information on, and better information on where you might be in the future, how much income you'll need and how much income you're likely to have based on your current situation, where your investments are, how they're invested, what your asset allocation is, how it should be, what you've been paying, all of these things. We usually do this. It's like a mini financial plan. A big financial plan is $1,500. My Retire Map is $199. During Retire Meet only, we offered it for $99, $100 off, using the discount code MEET. And you just go to retiremeet.com. Oh, you're already on Retire Meet. Just click on the Retire Map button and use the discount code MEET. This is only good through the 19th of March. Then it goes back to $199. It's $199 for everybody unless you've attended Retire Meet. And since you're attending it this way, we decided to give you the same discount. So you need to start with this plan and use the code MEET. You can also get it at talkingrealmoney.com. There's a link near the bottom of the page. Because you literally need this. You know you need the help. You know you've been doing it wrong. You've been building hodgepodge portfolios. You've got all these different things everywhere. You're trying to buy the latest hot thing. It doesn't work. Start with a plan, and your future is likely to look a whole lot brighter. Thanks for watching my part of Retire Meet. There are a lot of other links on the page for things you can explore. Look through them all at your leisure, but remember, the recorded version of Retire Meet will only stay up through the 19th of March. I hope I said March earlier. 19th of March, March 19th. If I said February, oops, I made a mistake. The Retire Meet code is good through the 19th of March. So, and this presentation will be up until the 19th of March. Then we'll pull it down. Thanks for attending. Hope you enjoy the rest of this version of Retire Meet. I'm Don McDonald. Check out our other stuff. Go to talkingrealmoney.com and enjoy the rest of your day. Take care.